Good evening and welcome to the program. Let us start with the key signals from Wall Street overnight. The three major indices held at elevated levels, with the Nasdaq closing at 25373, the S&P 500 at 7489, and the Dow at 52485. While the official percentage changes were not updated in our system, the internal structure told a much clearer story. Nvidia rose nearly 2% against the trend to close above $200. Tesla was up modestly, and the S&P ETF gained 0.5%. But the Nasdaq ETF was essentially flat, down a mere 4 basis points. On the other side, the crypto complex continued to bleed. The Bitcoin spot ETF fell almost 3%, MicroStrategy dropped more than 4.5%, and Bitcoin itself lost 1.14% over 24 hours, pulling back to around $63,000. What this tells us is that capital within the technology sector is clearly favoring AI compute hardware, rather than a broad expansion of risk appetite. Our screening radar flagged 7 U.S. stocks with 2-day gains exceeding 8%, including one name up over 30%, another up nearly 29%, and several others in the mid-teens. However, after cross-verification with independent news sources, none of these moves could be confirmed. By our rules, all of them are marked as pending verification and will not serve as the basis for today's main thesis. There were no confirmed significant outliers yesterday, so we will not make opportunity calls based on unverified information. Now to the global macro temperature gauge. The 10-year Treasury yield rose to 4.74%, up about 12 basis points over the past 7 sessions from 4.622%. This level means global liquidity conditions remain tight, putting valuation pressure on long-duration growth assets. The key levels to watch are simple. If the yield falls back below 4.6%, the pressure eases. If it breaks above 4.85%, growth stocks face further headwinds. The VIX printed at 15.99, comfortably within the normal 15 to 25 range, indicating stable market sentiment. However, the 22.6% decline over the past 7 days lacks independent external news confirmation, so we treat that as pending and rely on the current absolute level rather than extrapolating further downside. The dollar index broke below the 100 handle, closing at 99.80, down nearly 1% over the week. A weaker dollar is a positive external liquidity factor for emerging market assets and a constructive variable for the renminbi and foreign flows into A shares. Oil prices remain in the mid to high range, with WTI at 84.67 and Brent at 90.12. The tail risk of inflation is not fully off the table, but there are no new signs of a loss of control. Spot gold retreated 2.49% over the week to $4,049, suggesting a marginal cooling of safe haven demand. Our overall assessment is a structural risk on environment. AI compute hardware is the main thrust of capital allocation, but elevated treasury yields cap the broader valuation expansion, and crypto plus high valuation growth names continue to lose ground. The thesis is invalidated if the VIX breaks above 25, or if the 10-year yield breaks above 4.85. Either trigger and we flip the call. On the renminbi and China asset external environment, the onshore rate is 6.7505 and offshore is 6.7524. The offshore rate appreciated a marginal 0.06% over 7 days, and the onshore-offshore spread is only about 19 basis points. There is no depreciation pressure whatsoever. Combined with the dollar index breaking below 100, the external environment for the renminbi is broadly friendly, which supports foreign risk appetite toward A shares. On tariffs, trade, and technology controls, there are no confirmed new events, so no policy variables are disturbing the picture today. Since today is Saturday and markets are closed, the next A-share session is Monday, August 3rd. Our opening sentiment call is a modest gap up. The basis is straightforward. Friday saw the Chinext index surge 3.06% and the Shenzhen component rise 2.21%, so bullish momentum has carryover inertia. A weaker dollar provides external support. The call is invalidated if the offshore renminbi weakens past 6.78, or if Nasdaq futures turn negative during Monday's Asian session, or if the VIX jumps back above 20 overnight. Now to the A-share market outlook for the next session. Let us first review Friday's closing data. The Shanghai Composite rose 0.72% to 3,832 points, the CSI 300 gained 0.85%, but the SSE 50 fell 0.12% against the trend. The Shenzhen Component rose 2.21% to 13578, and the Chinex jumped 3.06% to 3343. This is a classic growth-style dominant session, with heavyweight blue chips lagging and capital concentrated in tech growth. For Monday, the Shanghai Index is likely to consolidate at high levels, while the Chinex faces the risk of a spike and pullback. The invalidation conditions are a Chinex open below 3,300, or a significant contraction in turnover compared to Friday. On the main sector line, the most likely active directions are the AI compute hardware chain and the data center segment within power equipment. The logic chain is clear. Friday's volume-driven Chinex rally established the growth style. Nvidia's counter-trend gain of nearly 2% validates AI compute demand. In the external supply chain, bottleneck segments like indium phosphide substrates, high-voltage transformers, and CoAS test equipment remain relatively strong. This maps to A-share optical modules, CPO, semiconductor materials and equipment, and data center power supplies and transformers. The call fails if the Chinex opens down more than 0.5%, or if the AI compute sector collectively weakens at the open. On risk avoidance, we steer clear of high-valuation pure theme stocks, micro-caps, and real estate chain blue chips. The reasoning is straightforward. With the 10-year Treasury at 4.74%, the market is rate-sensitive, and theme stock valuations have no room to expand. The SSE 50 has already fallen 0.12% against the trend, indicating a lack of incremental capital for heavyweight blue chips. On northbound flows, a weaker dollar plus stable renminbi suggests a higher probability of net inflows than outflows. The confirming signals are an offshore renminbi that stays firm during the session and Chinex turnover that does not shrink. If the renminbi turns weaker or volume collapses, the inflow call needs revision. On the stock radar, the market state is classified as a correction, with a risk budget of 0.45. We only take small positions in high-scoring bottleneck names and wait for the index to regain footing. The opportunity candidate is AXTI. Indium phosphide is a key substrate material for AI data center optical interconnects. The model predicts a spike and pullback or high-level consolidation over the next 1 to 3 trading days, with a probability of 58%. The trigger condition is the continuation of the AI optical communication bottleneck logic and the stock maintaining relative strength. The invalidation condition is a break below the day's low or further deterioration in market conditions. Position discipline requires only a small verification position, waiting for a pullback. It must be noted that AXTI's nearly 29% gain over 2 days has no independent news confirmation, so the move is pending verification. For existing holdings, AEHR is in the CoAS packaging and testing segment. Its relative strength during the market correction is 19.45%, and the price is well above the 200-day moving average. The model predicts relative resilience over the next 1 to 5 trading days with a 58% probability. Invalidation comes from a break below the 200-day average or a significant weakening in relative strength. The discipline is to continue holding, with consideration of partial profit taking. Another holding, 5802.T, is holding above the 200-day average, and the indium phosphide bottleneck logic remains intact. The model predicts relative resilience with a 58% probability. If it breaks below the 200-day average, the catch-up logic fails. Discipline is to continue holding. On the risk avoidance list, POET has broken below the 200-day moving average, has a large monthly decline, high short interest, and earnings approaching. The model predicts downside risk dominance over the next 1 to 5 trading days with a 65% probability. The invalidation condition is a reclaim of the key moving average along with a decline in short risk. The discipline is to cut or reduce the position and observe. AKTS and VICR are flagged as high short risk avoidance names. The model provides no clear probability, so they remain pending verification. The principle is to avoid or stop out. Let me close with today's core judgment in one sentence. The dollar breaking below parity combined with a strong Chi-next rally favors AI compute hardware, but the 4.74% Treasury yield caps the upside, so we wait for a pullback. Today's probability assessment is 40% up, 45% sideways, and 15% down. Thank you for watching, and we will see you next time.